Good morning. Allow me to discuss with you today uh, three topics. But before that, allow me to share my screen. Okay, so we will be discussing today. So our discussion for today will focus on one, effects of inventory errors on profit. Two, effect of change in inventory costing procedure. And three, purchase commitments. Okay, so we start with the first one, inventory errors. Okay, so our principle would revolve around the effect of beginning inventory and ending inventory on net income. As you may have recalled, we have previously discussed this, so let us take a review. So this is effect on profit and effect on cost of goods sold. Okay, so if beginning inventory is, let us say, understated. So beginning inventory is part of goods available for sale. So assuming that ending inventory is correctly stated, so if beginning inventory is understated, that means your goods available for sale will likewise be understated. And if there is no error in ending inventory, that means that your cost of goods sold is likewise understated. So that means that if beginning inventory is understated and cost of goods sold is understated, that means the profit will be overstated. And vice versa, meaning that if beginning inventory is overstated, then your cost of goods sold will also be overstated and your profit will be understated. Okay, therefore, beginning inventory again has an inverse effect on profit. Okay, what about ending inventory? So if ending inventory is understated and ending inventory is an item that is deducted from goods available for sale to arrive at cost of goods sold. So if ending inventory is understated, that means that the amount deducted from goods available for sale is understated. So your cost of goods sold would be overstated. And because cost of goods sold is an expense, if expense is overstated, then your net income will be understated. That means, therefore, that if ending inventory is understated, profit will also be understated. So, summarizing, that means, therefore, that ending inventory has a direct relationship on profit. Okay, what about purchases? So purchases, if not sold, will become part of your ending inventory. If sold, it will become part of cost of goods sold. So as an item, purchases actually is an expense. So if purchases were understated during the period, and because this is an expense which form part of cost of goods sold, then your cost of goods sold will be understated. And because this is an expense, it will overstate profit. Therefore, this one also has an inverse effect on profit. Okay, so following these principles, applying these principles now, let us discuss 1-28. Ensure that your book is with you, your physical book is with you. I do not know, but all accounting students have their physical books that they can highlight anytime and they can refer to whenever there is a need for them to go back to their previous lessons. And possessing your book will actually help you in your subsequent courses. Okay, so we have 1-28. The question is, calculate the correct profit before income tax for 2022. So profit for 2022. And determine the net effect of the foregoing errors on profit before income tax for the year 2021. So therefore, this is effect on 2021 profit. This is requirement letter A. This is requirement letter B. Okay, we do that. Examination of the records of Grant Company for the year ended December 31, 2022 revealed the following. Inventory at January 1, 2022 was overstated by 71,000 because some inventories were counted twice on December 31, 2021. So, analyzing the root cause of this error, that means that the December 31, 2021 inventory was overstated. Okay, so that means it will affect profit of 2021. So as far as 2021 is concerned, the December 31, 2021 inventory is an ending inventory and it was overstated by 71. So sabi natin, if ending inventory is overstated, it has a direct effect on profit. That means, therefore, that the profit for 2021 will also be overstated by the same amount, 71,000. The ending inventory of 2021 becomes the beginning inventory of 2022. And because the beginning inventory of 2022 was overstated, by the way, we have here ending inventory. Here we have beginning inventory. So a beginning inventory of 2022 is overstated and beginning inventory has their inverse effect on profit. That means that the profit for 2022 was understated by 71,000. Okay, next, goods in transit from a supplier on December 31, 2022 under FOB shipping point were appropriately recorded as purchases. So purchases for the year 2022 were correct, but were not included in the physical count. And the amount is 96,000. So that means that the December 31, 2022 inventory, it was not included, was understated. And because this took place at the end of 2022, it would not have an effect on 2021 profit, but it would affect, of course, our 2022 profit. This is 2022 ending inventory. So your inventory is understated. So this is ending. That means, therefore, that your net income is likewise understated by 96,000. Next, Grant recorded as sales a 60,000 invoice price of goods shipped to customers on December 30. The goods costing 52,000 were in transit at December 31. Therefore, the item in question is the selling price of 52,000 goods that were still in transit. and they were excluded from the ending inventory. 60% of these goods were shipped FOB shipping point, while the remaining goods were shipped FOB destination. So where did the error lie? The error lies in the recording of the goods that are sold FOB destination. For those goods that are sold FOB shipping point, the company is correct in recording that as sales of the year 2022. But for the goods that are sold FOB destination, they could not be considered as sales yet until they reach the customer's destination. Therefore, we have goods sold FOB destination is still in transit at December 31, 2022. Okay, so sales were overstated because they were recorded as sales already. So we will cancel the sales. That is 60% now of the goods were shipped FOB shipping point. Therefore, the sales that we will cancel will be 40% of 60,000. And 40% of 60,000 is 24,000. The fact that sales is overstated means that the profit is also overstated for the year 2022. However, these goods were also excluded from the ending inventory. Therefore, your ending inventory is understated because they have not been included in the count, but these are still ours. And the goods, the cost of the goods is 52,000. So that means, therefore, that 40% of 52,000 must be included in our inventory. And 40% of 52,000 is 20,800. So if ending inventory is understated, then your profit is understated. Of course, there is no effect on 2021 profit as this error was committed at the end of 2022. Then purchases of 100,000 were recorded when payment was made in 2022. Although the goods were received in 2021 and were included in the 2021 ending inventory. So whether the goods were shipped FOB shipping point or FOB destination, these are received already in 2021. Hence, they should have been recorded as purchases of 2021. Likewise, they should be included in the 2021 ending inventory. Okay, therefore, ending inventory of 2021 is correct, but beginning inventory likewise of 2022 is also correct because these items of purchases in 2021 were included in the 2021 ending inventory. But what is erroneous here is purchases. So these are purchases of 2021 recorded in 2022 when payment was made. And therefore, purchases of 2021 were understated because they were recorded as purchases of next year. So if purchases were understated, then your profit, because purchases is an expense, profit will be overstated, and that amounted to 100,000. And then these are purchases of 2021, but they were recorded as purchases of 2022. Therefore, purchases of 2022 were overstated. So if expenses were overstated, that means that profit would be understated. Okay, therefore, this is the net effect on profit. So for 2021, we have a total overstatement of 171,000. For 2022, our net effect, let us compute, that is understatement of 71,000 plus understatement of 96 minus overstatement of 24 plus 20,800 understatement plus 100,000 understatement. So we have 263,800 net effect. Let me just do it one more time. Okay, so we have a net understatement of 263,800, profit before income tax before adjustment. So profit before correction was reported as 658,000, and therefore your correct profit for the year 2022 is 921,800. Okay, I just verified. Okay, so I hope you would be applying these principles when you have your quiz number 3. So to reinforce, we will be using also the next exercise, 1-29. You are required to compute the adjusted income before taxes, so that is profit before taxes for the year 2021 and 2022. So profit for 2021 and profit for 2022. Okay, so the Lambda company reported income before taxes of 709,400. So we have reported profit before correction. We have 789,350 and no. So that is that's correct. 789,350 for 2021, no, 709. Ang kulit. So that is 709,400. So that is 709,400 for 2021 and 789,350 for 2022. The entity uses periodic system and takes a physical count of its inventory every December 31. Upon review of its records, the following data were discovered. Letter A, so adjustments. Letter A, an item of inventory comprising 2,200 were included in the 2021 ending inventory figure. These were costed at 98 per unit, whereas the correct unit cost is 81. Therefore, ending inventory of 2021 was overstated because they were valued at 98 instead of the correct unit cost of 89. So it was overstated. Okay, so the overstatement again is on 2,200 units multiplied by the difference between 98 and 89. So we have 9. So therefore, 2,200 times 9, that's 19,800. Okay, so if ending inventory was overstated, that means profit was likewise overstated for the year 2021, but ending inventory of 2021 would become the beginning inventory of 2022. And because it was overstated by 19,800, that means, because this is beginning inventory now, that the effect on profit is inverse. So we have understatement in profit of 2022 for 19,800. And letter B, on December 29, 2022, goods costing 57,000 were sold to a customer. The related invoice was issued to the customer and the sale was properly recorded on that date. Okay, so it was a sale of 2022 and the sale was properly recorded. However, the customer requested for a 3-day custody of the goods by Lambda Company and promised to pick them up on January 2, 2022. The goods were mistakenly included in the December 31 inventory count. Therefore, the December 31, 2022 inventory was overstated. Okay, so because this is ending inventory, it has a direct effect on profit. And therefore, if this is overstated, that means profit is likewise overstated by 57,000. But because this error took place at the end of 2022, it would not have any effect on profit in the year 2021. Therefore, computing, we have 709,400 minus 19,800. Our correct profit for 2021 is 689,600, whereas for 2022, that is 789,350 plus 19,800 minus 57,000. Okay, so that is 752,150. Okay, so please check your works. If you have not solved this, please solve this on your own and then check against this solution. Okay, we now go to the second topic for this session, and that is change in accounting policy in inventory costing procedure. Okay, so costing procedure is based on the company's policy. However, if the goods of the entity are specifically identifiable, you cannot make the change in inventory costing procedure because the only costing procedure available for that company is the specific identification method. So, kailan lang pwedeng gamitin o kailan lang pwedeng mangyari yung change in inventory costing procedure. That is, if the goods are not specifically identifiable, because the costing procedure that will be adopted by the company will depend upon the accounting policy of the entity for the inventory costing, and therefore the possible changes will only be from FIFO to weighted average or vice versa. That is from weighted average to FIFO. Okay, so how do we account for change in accounting policy? So this is considered to be accounting policy, and you have taken this up in your conceptual framework. If you are now to apply the principles you have learned in your conceptual framework, the change in accounting policy is considered as an adjustment in the beginning balance of retained earnings or another component of equity that another component of equity does not apply to inventory. It applies only to other changes in accounting policy. So therefore, this is considered as an adjustment in the beginning balance of retained earnings. Kailan? In the earliest prior period, comparative prior period presented in the financial statements. And as you have taken up also in your conceptual framework, at a minimum, you have to include also the comparative prior period financial statements, at least for the last preceding year. And therefore, how do we account for the change and how do we measure the effect of the change? So the effect of the change is the difference in beginning inventory net of applicable income tax. So if income tax is 25%, that means therefore that will be 75% of the difference in inventory value. Comparing now the old method and the new method. And then we will apply the same principle that beginning inventory has an inverse effect on profit, whereas ending inventory has a direct effect on profit. Okay, so to illustrate, we will be using 1-11. So go back to 1-11 in your book. You are required to determine the profit of Santa Lucia Company for each of the 3 years had the company used the FIFO costing method. So these 3 years are 2020, 2021, and 2022. Okay, so the Santa Lucia Company organized in 2020 used the average costing method. So that means that the old method is the weighted average method. It is considering to change its inventory costing policy and to adopt the FIFO basis. Therefore, it is contemplating to adopt a new costing procedure, which is FIFO. Profit under the average costing method and inventory cost based on both average and FIFO methods are shown below. Therefore, we start with profit under the old method. So that is profit under average method. O, lagay na natin lahat. We have 3,600,000. This is the first year of operations of the company. It was organized only in 2020. In 2021, it was 5 million. And in 2022, the reported profit is 7 million. So how would profit be affected if they would use the new costing procedure that is FIFO? Therefore, we will determine the difference in ending inventory. Beginning muna tayo. Difference in beginning inventory, that is FIFO as against the average costing. And we will determine the difference in ending inventory. That is, you are to compare the new method of FIFO over average, compared with average. Okay, because 2020 is the first year of operating the entity, that means therefore that there is no beginning inventory. So wala tayong beginning. So there is no effect on beginning inventory for 2020. Whereas the difference in ending inventory, so that is at the end of 2020, under the average basis, that's 1,200,000, but under the FIFO basis, that's 1,240,000. And please take note that the FIFO basis inventory is consistently higher than the average basis. So this one is higher, this one is higher. So if FIFO basis inventory is consistently higher than the weighted average method, and under the FIFO, the goods will be valued at the most recent purchase price. That means, therefore, that the purchase price during each period, 2020, 2021, and 2022, were consistently increasing, meaning pataas ang presyo. We are in the period of inflation. So in the year 2020, the FIFO basis inventory is higher by 40,000. That is 1,240 minus 1,2. The higher is the ending inventory, the higher is the profit. Therefore, this one must be added. So this is 3,640. Again, the higher is the ending inventory because it has direct effect on net income. The higher will be the profit. The higher will be the net income. But the ending inventory for 2020 becomes the beginning inventory of 2021. Therefore, the difference in beginning inventory here will be 40,000. The higher is the beginning inventory, and beginning inventory has an inverse relationship to profit. That means that the lower is the profit. Therefore, you are to deduct 40,000. Then at the end of the year, the average basis inventory is 1,300, whereas the FIFO basis is 1,420. So the FIFO basis inventory, ending inventory is higher by 120. So the higher is the ending inventory, the higher is the profit. Therefore, that's 5 million minus 40 plus 120. So that is 5,080,000. But again, the ending inventory of 2021 is the beginning inventory of 2022. Therefore, 120,000 is the difference in their beginning inventory. And the higher is the beginning inventory, the lower is the profit. So therefore, you deduct. And at the end of the year, the FIFO basis inventory is 2,650,000, whereas the average basis inventory is 2 million. So that you have 650,000 difference. So the higher is the ending inventory, the higher is the profit. Therefore, that is 7 million minus 120 plus 650. And that is 7,530,000. Okay. The current year is the year 2022. This one, current year 2022. So if you are to prepare entries in 2022 to reflect the change, what will be our entries? Okay, so your inventory, how much is the difference there? Okay, so your retained earnings. So for the prior year, your retained earnings will have, considering the two, you have 5,080,000 and 3,640 compared to the prior year profit of 3,600,000 and 5,000,000. Okay, so reported prior year profit. So we have 3,600,000 plus 5,000,000. Therefore, that's 8,600,000. Whereas reported or profit under the new method is 5,080,000 and 3,640. So it's 8,720. Therefore, the difference is 120, and that difference actually will increase retained earnings. Therefore, your entry is to credit retained earnings. That is to increase our beginning retained earnings for the year. We are disregarding the income tax effect. And please take note that this is the same difference as in the beginning inventory. Therefore, you are to debit inventory beginning because the company uses the periodic inventory. If the company uses the perpetual, then this will be debited to the current year cost of sales. Okay, so your beginning inventory must be higher by 120,000. So if the company uses periodic before closing, your beginning inventory, you have to adjust it first. So debit inventory beginning 120, credit retained earnings 120. If the company uses perpetual, then debit cost of sales 120 and credit retained earnings 120. But for your ending inventory, only if periodic, because for perpetual, there is no need for you to take up. All you need to do is to increase your inventory. Okay, so your ending inventory is to be increased by 650. So credit inventory and as an adjustment to previous, assuming that ending inventory has already been set up, 650,000. That's for the difference only, and credit income summary or If the company uses the cost of sales or perpetual inventory method, credit cost of sales, 650. Okay. We go to the third topic, and that is purchase commitment. So purchase commitment is actually an executory contract. Why is it executory? Because you only entered into a contract to buy goods from another entity at a future date. And actually, if that contract, what's the purpose of purchase commitment? So purposes, this may fall under any of this. One, to lock in prices. So you are anticipating that prices of commodities will go up. So as early as now, kung wala kayong enough space in your warehouse, you are not to buy now, but you are to buy later. However, you are to lock in prices now in anticipation for anticipated increased prices. So that may be done. Number two, to assure supply. So if the product is saleable, supply of goods. So that you want to be assured that there will be enough supply in the future, you enter into a purchase commitment with your valued supplier. So if purchase commitment is cancelable, no accounting procedure is necessary, meaning there is no need for you to record, because that is an executory contract. There is no value received, there is no value parted with. If it is non-cancelable, you have to disclose this in the notes to the financial statements. Magkukwento lang kayo that you entered into a purchase commitment for so many units of product at designated purchase price. Now, there will be special accounting entries if the purchase commitment is non-cancelable and there is at year end decline in prices, decline in fair value or purchase price of goods committed to be purchased. Why is that so? Because we are applying the principle of prudence, we are applying conservatism. Okay, so to exemplify, we will be using the last exercise in your book before the multiple choice. So that is 1-30. Okay, so during 2022, USFO company signed a non-cancelable. Please highlight in your book. It's non-cancelable contract with Nueva Ecija Milling Company to purchase 1,000 sacks of rice at 1,200,000. So therefore, the committed price is 1,000 sacks at 1,200,000. So that is 1,200,000. So you are committed to buy at 1,200,000. On December 31, 2022, the price of rice had fallen to 150 per sack, and therefore your loss. So on December 31, 2022, you are to prepare an entry. So if there is a decline in the purchase price or fair value of the goods you committed to purchase, then you are to record the loss. We debit loss on purchase commitments. And credit estimated liability on purchase commitment. So that is 1,200 sacks. The committed price is 1,200, but it had fallen to 1,150. So therefore, there is 50 pesos decrease in the fair value. So that's 50 times 1,200. So that is, tama ba? No, 1,000 lang pala. So 1,000 times 50, that's 50,000. So your entry on December 31, 2022, debit loss on purchase commitment, 50,000, and credit estimated liability on purchase commitment, 50,000. Now, in the subsequent period, what is the accounting procedure? Your purchases must be recorded at the lower between the actual price, actual purchase price, the actual fair value, the actual fair value at the time of purchase, and committed price. Kung tumaas, then nag-gain kayo, but the gain will not be recorded. The gain will be realized when you are able to sell the goods. The accounts payable will be recorded at the committed price. Then the recognize the previously recorded estimated liability on purchase commitment. So you are to recognize this 50,000 in this exercise. If there is recovery, the recovery is limited to previously recognized loss. If there is further decline, then record additional loss. Okay, let us exemplify. Please take note that on December 31, 2022, we have this entry already. So at December 31, 2022, you record a loss account. So that is an expense account. Debit loss on purchase commitment, 50,000. So it will actually decrease your profit in 2022 for 50,000, and then you are recording a current liability on purchase commitment, 50,000. Okay, give the entries on December 31, 2022. So that is the entry on December 31, 2022, and on February 28, 2023. Under the date of the actual purchase. So this is actual purchase. When the market price on February 28, 2023 of each sack of rice is letter A, so assumption A. Market price is 1,150. Ano sinabi natin? Our purchases must be recorded at the lower between the actual fair value and the committed price. And the committed price is 1,200. The actual fair value is 1,150. And therefore, your entry here is to debit purchases. That is 1,000 times 1,150. So that's 1,150,000. And then, what shall we do? Your accounts payable must be recorded at the committed price. Of course, you are committed to that. So, record accounts payable. Your committed price is 1,000 times 1,200. So therefore, that's 1,200,000. Next, you are to recognize the previously recorded estimated liability. So debit estimated liability on purchase commitment, and your estimated liability as recorded is 50,000. Okay, so at this point, your entry is already balanced. That is so because the market price is also at February 28, 2023, is also the market price at December 31, 2022. So there is no further decline and there is no recovery. Hence, we have this entry. Then assumption B. The market price further declined to 1,100,000. Okay, therefore, what will be our entry? We debit purchases at what? At the lower between the committed price and the actual price on the date of actual purchase. And the committed price is 1,200,000, whereas the fair value or the market price at the date of actual purchase is 1,100,000. So therefore, this will be recorded at 1,000 times 1,100. So that's 1,100,000. You are to credit accounts payable at the committed price. So that is 1,000 times 1,200 pa rin. Therefore, that's 1,200,000. You are to recognize the previously recorded estimated liability of purchase commitment. Do not forget to cancel it. So we debit estimated liability on purchase commitment, which is 50,000. And because there was a further decline of this 1,000 units from 1,150 to 1,100, then there is additional decline of 50,000. So for this 50,000, you record additional loss on purchase commitment for 50,000. So if there is a further decline, then in the subsequent period, in the period of actual purchase, you are to record additional loss. Then assumption C. Market price recovered to what? 1,200,000. Okay, 1,200,000 is actually the committed price. So committed price, in this case, market price is equal to the committed price. Therefore, your entry, debit purchases, sabi natin at the lower, but they are equal. So that is 1,000 times 1,200,000. So that is 1,200,000. Credit accounts payable at the committed price. So that's 1,000 times 1,200,000. 1,200,000. So tapos na ba yung entry natin? Sabi natin hindi. Do not forget to recognize your previously recorded estimated liabilities. So debit estimated liability on purchase commitment, that is 50,000 as we recorded on December 31, 2022. And then credit again, which is recovery on purchase commitment for 50,000. So do not forget to cancel this. That means therefore that if we are canceling this, that means we recovered the market price to 50,000. Now assuming, lagyan natin ng isang assumption. Assumption D, market price recovered to even higher. Let us say 1,250. Okay, so what shall we do? Sabi natin, your purchases must be recorded at the lower between the market price and the committed price. And therefore, the lower between 1,200,000 and 1,250. So this is lower than 1,200,000. Is still 1,200,000. So we debit purchases 1,000 times 1,200,000, 1,200,000. record accounts payable. Also at the committed price, 1,000 times 1,2, so that's 1,200,000. Debit estimated liability on purchase commitment for 50,000 and credit recovery on purchase commitment, which is again for 50,000. Therefore, your entry under letter D, which we added only, is the same as your entry in letter C. So if the market price recovered to an amount higher than your committed price, of course, the amount of the recovery will only be limited to the amount of the previous loss that was recorded. Okay. With that, therefore, you just go over your course site. I might be uploading some more materials, probably the multiple choice, if it would permit me to upload some more. Otherwise, this will be the end of our discussion in preparation for your exam. With that, I hope you had a very meaningful recollection. I will not meet you again, or probably I may open the Zoom this afternoon, but I will be entertaining questions only.